The American dream has long been tied to the idea of homeownership. For generations, purchasing a home has been seen as a key stepping stone toward financial stability and a significant part of building long-term wealth. In fact, owning a home has historically been one of the most reliable ways to secure one's place in the middle class, providing a sense of security and a valuable asset that appreciates in value over time. Please hit subscribe button for more informative videos. A historical perspective on homeownership. The promise of homeownership in the United States has always been about more than just the physical property. It's about the potential for growth and stability. Historically, the value of homes has tended to rise over time, outpacing inflation. This trend has created an environment in which owning a home wasn't just a place to live, but also a way to build wealth. The concept was simple. Buy a house, and over the years, the value of that house would increase, creating equity for the homeowner. Looking back, we see that buying a home has always required a combination of hard work and financial commitment, with a significant down payment and the responsibility of a mortgage. However, these costs were more manageable for the average American family compared to what we are seeing today. This basic formula, save money, borrow money, own property, was the backbone of the American dream. The growing gap between wages and home prices. Fast forward to today, and the picture has changed dramatically. While home values have continued to rise, wages have failed to keep pace with these increases. The gap between the median income and the median home price in the U.S. has reached levels not seen in the past several decades. To understand how steep this climb has become, let's look at the data from the past 50 years. In 1972, the median household income in the U.S. was around $10,000, and the median home price was about $29,000. This meant that the cost of purchasing a home was roughly 3 times the household income. For many, this was a challenge, but it was still an attainable goal. A young person could graduate from high school, find a full-time job, and afford a home with some planning and saving. The role of interest rates. While the disparity between home prices and wages plays a major role in the difficulty of buying a home, interest rates also have a significant impact on affordability. The cost of a mortgage depends not only on the price of the home, but also on the interest rate. Historically, interest rates on mortgages have been somewhat volatile, but they have generally decreased over the past few decades, making monthly payments more affordable. However, recent trends have seen a sharp increase in mortgage rates. In response to inflation, the U.S. government has raised interest rates to slow down the economy. As a result, the cost of borrowing has risen, making it even more expensive to purchase a home. This has compounded the problem of high home prices, further limiting access to homeownership for many Americans. In 2020, the COVID-19 pandemic led to a surge in demand for homes, which in turn drove up prices. By 2022, interest rates began to rise sharply as the Federal Reserve took action to combat inflation. The combination of high home prices and rising interest rates has created a perfect storm, pushing homeownership further out of reach for many Americans. The supply and demand imbalance. Another key factor in the rising cost of housing is the supply-demand imbalance. The supply of available homes in the U.S. has not kept up with demand, and this has driven up prices. One of the main reasons for this shortage is restrictive zoning laws. These local regulations dictate where homes can and cannot be built, the number of units a building can have, and the density of housing in a given area. These laws often limit the construction of new homes, particularly affordable ones, exacerbating the shortage. In addition to zoning restrictions, the overall rate of new construction has been slow. Builders are often reluctant to construct new homes in certain markets because the cost of land, labor, and materials has increased, making it less profitable to build homes for lower-income buyers. This has further contributed to the lack of affordable housing. The impact of student loan debt. In addition to the challenges posed by rising home prices, interest rates, and a shortage of housing supply, many young people in the U.S. face another significant barrier to homeownership: student loan debt. With the cost of higher education rising, many Americans are leaving college with substantial student loan debt, which can make it difficult to save for a down payment on a home. Student loan debt has become a significant burden for many young adults, preventing them from saving for a down payment and limiting their ability to qualify for a mortgage. This is especially true for those with significant amounts of debt and lower-paying jobs, as they may struggle to meet the income requirements for a home loan. Racial disparities in homeownership. The barriers to homeownership are not the same for everyone. People of color, particularly Black Americans, face additional challenges in the housing market. Studies have shown that people of color are more likely to be denied mortgage loans, regardless of their income. This disparity has deep historical roots, dating back to practices such as redlining, which excluded minority communities from access to home loans. Even today, racial discrimination in the housing market continues to be a significant issue, preventing many people of color from achieving homeownership and building wealth through property ownership. This inequality further exacerbates the challenges faced by minority communities in an already difficult housing market. Can renting be a path to financial stability? With the barriers to homeownership rising, many young people are beginning to question whether buying a home is still a feasible goal. Given the increasing difficulty of purchasing a home, it's natural to wonder if renting is a viable alternative for achieving financial stability. The answer isn't simple. While renting a home doesn't provide the same long-term wealth-building potential as owning one, it can offer flexibility and lower upfront costs. Renting also eliminates the risks associated with homeownership, such as property depreciation or the burden of costly repairs. However, renting also means that individuals are not building equity in a property. Instead of paying down a mortgage and eventually owning the property, renters are essentially paying someone else's mortgage without gaining ownership of the asset. For many, this trade-off can feel like a step backward in terms of financial stability. Conclusion: the dream of homeownership is becoming increasingly difficult to achieve for many Americans, particularly those in lower-income and middle-class households. The rising cost of homes, stagnant wages, high interest rates, and a shortage of available properties have made it harder than ever to buy a home. Additionally, student loan debt and racial disparities in the housing market further complicate the situation. As the housing market continues to evolve, it's essential for individuals to consider all their options and make informed decisions about their financial future. Homeownership may be out of reach for some, but with the right strategies and investments, it's still possible to build wealth and achieve financial security. Thanks for watching. If you enjoy this video, please don't forget to like, subscribe, and press the bell icon. See you in the next video.